Good afternoon or good morning, depending on where you are. Welcome to our webinar here today from Stockopedia. This is the fourth webinar in our series called Investing Mastermind series, where we've been interviewing fund managers and investors throughout the market, getting to understand their approach to investing and learn from the best so we can take control of our investing destiny. Today, I'm joined by Ron Shamgar from TAMIM Asset Management. You can see Ron there below me. But first of all, I'll just go through a few formalities and then I'll formally introduce Ron to you. So, of course, the first thing I have to do is address the important information, the disclaimer. Please be aware that none of this advice or none of this information is personal advice. We obviously don't know your personal circumstances. So if you do wish to take any action based on the comments that we make, you need to seek the advice of someone who's licensed to give that advice to you. And of course, as always, past performance is not an indicator of future performance. Now, this is an interactive webinar, so please do join in and give us your comments and questions. You can see on the right-hand side of your screen a chat box. If you type your questions in there, either myself or my colleague Elio, who's in the background, we'll get to those. We'll try and address them in the webinar itself if we can. If not, we'll give you a typed answer or respond to you later after the event. This is also being recorded, so if you miss something or you want to scrutinize the slides in more detail, don't worry. We will send you a copy of the recording so you can look at that at your own time. So, allow me to introduce to you Ron Shamgar. Ron's the Head of Australian Equities at TAMIM Asset Management, and he's been there for the last 6 years. He oversees two of their funds, one being the Australia All Cap Fund and also the Australia Small Cap Income Fund. Ron, great to have you with us, and thanks very much for joining us today.
Hey, good afternoon, and thanks for having me.
So, Ron, maybe you could start just by telling us a little bit about your investing journey, also, the personal side as well as the professional side of it, and how you got to this point.
Yeah, sure. So I've been investing in the market for the last 21 years, and it's been a really exciting journey. And although it's my daytime job, I'm really passionate about it, and that's really all I want to do in life. So I love what I do. I started as a private investor, managing my own money and my family money, and then transitioned into launching a fund about 11 years ago. It was a small cap fund. We ran that with a partner for close to 5 years. And then after that, I joined TAMIM Asset Management just under 6 years ago. So at the end of this year will be 6 years, and I took over managing the Australian All Cap Fund, and then launched a new fund, the Small Cap Dividend Fund. So yeah, it's been a good journey.
Excellent. So I guess people want to get into the meat of the presentation now. As you know, we've titled this presentation Finding Diamonds in the Rough, and we will talk today about a whole bunch of stocks. I know everyone likes to get their teeth into some stocks, and we'll also talk about the process that Ron and his team go through to find these opportunities. First of all, I'll just give Ron a quick opportunity to speak to his disclaimer.
Yeah, sure. So yeah, look, like you've mentioned before, none of the information we're giving today is financial advice. And so please do your own research, get your own personal independent financial advice. And although past performance is not an indication of future, we do hope that it is.
That's right. The performance of late has been rather good. So tell us a little bit about your business, Ron, and the funds that you manage there.
Yeah, sure. So TAMIM Asset Management is a boutique investment management firm based in Sydney. We've been around for about 10 years. And we offer investors basically a range of investment products. We have the equity side of the business. Obviously, the Australian equity funds, as I mentioned before, are managed by myself. We also have some global equity funds, which are managed by a couple of other fund managers. There's also a global tech fund, a mobility fund, and just a general international fund. We also have the property side of the business where we have property investment, single asset syndicates, mostly commercial and office. And we also offer a private debt credit fund, which is a fund of funds. We manage about $250 million in total.
Fantastic. Now, looking at this chart here, this is your track record. I can see those yellow bars. They're actually your fund's performance. And by the looks of it, you've done very well, other than 2022, which was a bit of a down year. But the rest of the time, you've really outperformed strongly. Maybe just tell us a bit about that.
Yeah, sure. So this is the flagship all-cap fund, which I've been managing for 5.5 years. Without beating my own drum, we've just been rated by Morningstar as the second best performing fund for financial year 24 with a 36% net return. And over 5 years, which I think is more important, we've rated top 5 in Australia with about a 16 or 17% annualized net return. Those are calendar year returns. So obviously the last 5.5 calendar years. Just one thing to note, that 2022 bear market was a really tough year, and some of those headwinds that impacted us there, which I'll talk about in the next few slides, are actually going to turn into tailwinds. So that's quite good. So if you actually exclude that 1 year, over those 4.5 other calendar years, we're actually averaging 30% net return. So if we think that the next few years will be quite good, which I'll talk to, so I think those annual returns will only go higher.
Excellent. And go ahead.
Yeah, I mean, this just basically shows $1 million invested with us 5.5 years ago. Essentially, 17% translates to $2.5 million after all fees today. So that's kind of the returns of that type of annualized return.
Yeah, and well ahead of the market, which is an excellent performance. So, as we all know, markets have been having a great run of late, and they're near or at record highs, both here and in the US. Interest rates almost certain to be cut in the US next week when the Fed meet. And here it would appear that rates are likely to remain on hold for a while yet, listening to our RBA governor. So give us a bit of an overview of your view of the markets from here and how you're feeling about things right now.
Yeah, sure. So there's a few things to note first up. So first of all, although we invest only in ASX listed companies, we always gaze into the US. So I'm going to talk about a lot of US macro stuff, because what investors in Australia need to understand is that whatever happens in the US is going to drive investor sentiment in Australia. So we need to understand the US economy. We need to understand the US interest rate environment, and that will translate on their stock market, which in turn will drive our stock market. So it's almost what happens in Australia macro-wise is less important for our stock market, which is a bit strange, but that's just the way it works. And if you don't understand it, you're going to struggle. So you need to really understand it. So I just want to put that as a disclaimer up front, which is why I'm talking about the US. So essentially, if you think about it, as you mentioned, yes, they will cut rates next week. They say there's a couple of certainties in life, death and taxes. Well, the third one is they're cutting rates in the US next week. You can be sure of that. The question is whether it's the 25 basis points or will they go 50? Most likely 25. And really, if you think about what I mentioned before, that 2022 bear market year, which was probably a top 5 worst bear market in the last 100 years, is a pretty tough bear market. It was really driven by very high inflation and interest rate rise trajectory, which was really aggressive, going from 0 to 5.5% in the US. And obviously that is very negative for equity markets in general, and it's very negative for the small to mid-cap part of the market. So in the US, they have the Russell 2000. In Australia, we have the ASX Small Ordinary Index. And that's really struggled because of that high interest rate hike cycle. Now, all those headwinds are now going to start to turn into tailwinds for us as they start cutting rates in the US. Well, I think we're going to see a lot of capital shift from those large mega caps, those magnificent seven, so to speak, that drove most of the returns in the last 12 to 18 months, will start going down into the sort of small and mid-cap part of the market, and we'll see that also happen in Australia as well. So, really this slide just talks to, that sort of inflation number in the US. I mean, we had the latest print overnight, which came in between 2.5% to 3.2%, depending, which measure you look at. And that is very low compared to the current rate of 5.5%. So they're definitely cutting by about 1.5% over the next 6 months. And I think that's going to be very, very bullish for equity markets. And I also quickly mention here, there is a slide here on the left, a chart here on the left, which essentially looks at US presidential election sort of terms, which are 4 years. And it shows how markets over the last 60 years behave over that 4-year period. And so what's interesting, this is an 8-month-old chart. And the reason we use it is because we know the future. So it shows you the first 3 years of the current Biden term. And the last year, this current year, which is obviously an election year, which tends to be very positive for stocks, we now know that light blue line has actually followed that average over the last six years. And the market has actually gone up according to that. And as you can see, maybe it's a bit small, but as you can see towards the end of that line, there's a bit of volatility and a pullback. And it usually happens in September and October. So it's actually playing almost perfectly. And we believe that once we get through this, a little bit of uncertainty in terms of who's going to get elected, whether it's Trump or Harris, I think, and in conjunction, we'll get these interest rate cuts. I think you'll see a big rally in November and December, and then we believe in the next few years. And so that's kind of what this slide is talking to.
And if I heard you right, you think that rally will be spread out more broadly across the market, not just the Magnificent Seven. Is that right?
Yes. In fact, I believe that those large mega caps will struggle a bit, and it will be below them the small to mid caps that will actually carry most of the returns in the short to medium term.
Excellent. Now, you're known as a bit of an expert in the small cap space. How do you see the outlook for the small cap stocks at the moment?
Yeah, so what's interesting is that, as I mentioned, small and mid caps have really underperformed their larger cap peers. In fact, both in the US and both in Australia, it's been quite similar. The underperformance has been probably the greatest in the last 25 years. So it's been really tough out there for the small and mid caps relative to the large caps. Although we've done extremely well during this period, I'm just talking generally, and the index has really struggled. So unless you pick the right stocks, the index has actually really struggled. And also in terms of the valuations, the small caps are trading at a discount to their larger cap peers. And historically, small caps tend to have higher growth rates, and they tend to trade at a premium valuation to large caps. So, we think that that shift is going to happen as they start cutting rates and as that sentiment changes. And I think we'll see really strong returns over the next few years in that sort of smaller end of the market. And obviously, you have to pick the right companies, and you're going to have to avoid certain sectors as well.
Okay. So now I'm sure everyone wants to know what you're thinking. Well, everyone sort of is of the view, the markets are really high. Surely we must be due for correction. What do you say to investors that are thinking about that?
Yeah, so if there's any slide that investors should take away from today's webinar, this is the one. This is really the most important slide, I think, and we really try and hammer this slide to investors. So I'm going to talk to it a little bit. So basically, we always get asked, when's the best time to invest? Have I missed it? It's already gone up. Is it too late? Is the market going to crash again? Is there going to be a correction? Investors are always trying to time the market. And what we're trying to tell investors is really simple. This is basically the S&P 500 over the last 80, 85 years. And essentially what it shows is that the dark sort of purple color, these are your bull markets, okay? And that and those little blips, orange colored blips, those are your bear markets, okay? Now, bull markets usually tend to last on average for about 5 years, And just to be clear, a bull market is if the market goes 20% or more, and a bear market is if the market drops by 20% or more. And so the bull markets tend to average 5 years, and they tend to go up by about 150%. Okay, that's your average. And then your bear markets, they can be quite nasty, as we all know, but they're very short-lived. So as you can see, the average bear market actually only goes for about 12 to 14 months. Now, the last bear market was in 2022, and it lasted pretty much, depending how you measure it, somewhere between 12 to 14 months. So we are currently now that's the last orange blip on that slide on the right side, and this is probably an 8 months old chart. So as you can see, that little blue, that little purple beginning of a bull market at the end, that's the current bull market. So the current bull market is, let's say, it's about 1.5 years old, and it's roughly up about 35 to 40%. Okay, so this is a very young bull market, and there is a lot of upside, both in terms of time frame. So they last for at least 5 years, and they go up for at least 150%. So there's still huge upside. Now, what's interesting here is that every kind of maybe 20 years, call it, there is what's called a bit of an industrial revolution that happens. Something that happens that drives a lot of investment, innovation, that drives a lot of productivity gains for companies, creates new businesses, new industries, and obviously that drives markets as well. Now, the last one was in the 1990s, and that was essentially the technology internet revolution that emerged in the mid-90s. And if you look at the chart where the sort of mid-90s are, that was a 12-year bull market. So we believe that the artificial intelligence or AI revolution that's currently happening, it's no longer a buzzword, but we actually believe that this is basically like being right now in the sort of mid to late 1990s, and the internet was just invented. Now, what we're seeing is that if you think about the 1990s, in order to have the internet, you got to spend the capex. What was the capex back then? You had to build the fiber to run internet connections, and you had to have all the equipment that companies like Cisco and the like did really well back then in order to connect and collaborate, and all your IT connectivity for firms. So with AI, you need two things. You need computing power, which is essentially the chips that NVIDIA sells, and that's why they're doing really well. And you need data centers, and that's why data centers are basically the hottest thing out there. We've just seen AirTrunk being sold for about $24 billion. So this is the initial stage of a revolution like this, is you invest in capex, and then at some point down the line, the capex spend sort of tapers off and drops, and then you have all the application layers on top. So if you think about, again, going back to the 1990s, then you have your Googles and your Amazons and your Facebooks and whatever it is emerge on top of that and create these applications and drive revenue. So, with AI, a company like OpenAI, which owns ChatGPT, is a good example. They were launched 2.5 years ago, and they went from zero revenues to they're currently annualizing $5 billion revenue, annualized recurring revenue, which is quite phenomenal in 2.5 years. And in fact, overnight, they announced a $6.5 billion raise at a $150 billion valuation. So AI is real. And what's interesting is that AI is not just going to benefit the NVIDIAs of the world. It's actually going to benefit entire industries that are unrelated. So, for example, we're already seeing healthcare companies such as radiology businesses using AI applications to help them look at images and x-rays and so on, and identify for them things that will take them, instead of doing 100 images a day, they can do 300 images a day. So they're making them more productive, generating them more revenue, and also obviously saving lives in that case. We're talking to health practitioners who are using AI applications to actually record the consultations with their patients, and then instead of the end of the day spending a couple of hours of going through and trying to summarize everything is already summarized for them with some recommendations as well. So again, making them more productive and efficient. We're seeing e-commerce businesses such as Temple and Webster, which is essentially an online furniture business, they've developed an in-house AI tool, which basically handles almost 50% of all customer product recommendations and customer inquiries. It saved them $4 million last year, and they reckon it's going to save them another $8 million in the next 1 to 2 years. So this is real, and it's happening, and we think it's going to drive a lot of innovation, investment, productivity gains, and profit margin growth for companies. And I think that because of that, if you think about the US, it's the most innovative country in the world. They always lead these innovation revolutions. And we think that they're going to do really well from this. And therefore, we believe that we're at the beginning of a mega bull market, which will probably go for another 10 years. And so that is kind of the picture that I'm painting. Now, I just want to make a disclaimer. Even in bull markets, you still, on average, have 3 pullbacks every year. In fact, if you don't have one, it's not good, okay? So you want pullbacks, and the average pullbacks is between 5 to 15%, okay? So what's interesting is that this calendar year, we haven't had one until the 1st of August, which we know that the market kind of pulled. I think it went down somewhere between 5 to 10%, depending which sort of index you look at. And that's a really healthy pullback. We saw one again earlier this month. So, you know, you kind of want to embrace these pullbacks, and you want to use them as opportunities to take advantage and buy companies that you like. And so, you know, just because you have a 10% pullback, don't think that, oh, this is the beginning of a bear market or whatever. No, this is just part of a normal bull market cycle. So it's really important to understand that. And so, you know, in fact, if you look at history and you look at this chart, it's very rare to have consecutive bear markets, you know, it's such a short interval between them. It almost never happens. And COVID crash wasn't a bear market technically because it was really a crash. So it only lasted for a month. So that's kind of what I'm trying to sort of talk about this slide. And then maybe one more thing, if I can mention, it's not on this slide, but there's been a study over the last 60 years, and essentially compared 2 different investment strategies. The first one is buying stocks only when the market makes all-time new highs. And the second strategy is buying stocks when the market is not at an all-time new high. Now, intuitively, you say, well, you know, if you're buying when the market is an all-time high, you probably underperformed in the last 60 years. Well, actually, you've actually outperformed. So buying at all new all-time highs of the index actually is a better strategy. And it makes sense because if most of the time markets are in bull markets and they go up over time, then usually if the market is making a new all-time high, you're probably in an uptrend. And from a logical point of view, the market is really made up of a bunch of companies. And if the companies are making new all-time highs, it means that underneath, the business is doing really well. Something good is happening. So think about it this way.
And while we're on that theme of looking at the markets and where they might be going, Richard in our audience has raised a question referring to the yield curve. So the US bond curve, it's been inverse or negative for the last 600 days, and that tends to be an indicator of a recession. Now, I researched this myself some time ago, and it's a really interesting situation. We've gone such a long period, and yet there hasn't been a recession. In fact, the US economy is quite strong. What's your view on, the yield curve, the impact that might have on both the economy and the market itself?
Yeah, look, there's no doubt that there is obviously a risk of a recession. I actually believe that both the US and Australia are in a recession, but they're in a consumer recession. And I think that other parts of the market, government spending, infrastructure spending, and maybe certain sectors are actually making up for it. But I believe that consumer part of the market, the consumer is in a recession, so to speak. And so, look, you could have a recession. I mean, but what is a recession? It's just 2 consecutive quarters of negative GDP. So, you could have it. I mean, we have seen downward revisions to the US GDP in the last, I think, 1 or 2 quarters, but it's still not negative. Like I said, they are going to cut rates. I think that will obviously be quite positive for sentiment, both businesses and for consumers. If you look at Australia, you know, I know that everyone's saying they're not going to cut rates this year, but if you look back at the New Zealand, their sort of RBA, back in May, they said we ain't cutting rates. And 2 months ago, they cut rates, okay? So, you know, these central bankers, they really react to the data, and there's no doubt that economies are decelerating. And so I think they will cut rates. And obviously, I think Australia is maybe probably 3 to 6 months behind the US. And you know, yes, we might have a very sort of light recession. And again, that may have a potentially sort of maybe, like I said, a normal pullback to the market. But then again, if you look at history, when a recession is actually confirmed, that usually means markets already are rallying. So the markets are always trying to anticipate that. So yeah, it's going to be interesting to watch. But like I said, you look at this chart, the majority of time, markets are in bull markets, they go up, you pick the right businesses in the right sectors, I think you're going to do really well.
Yeah, absolutely. So I guess everyone wants to know, how do you go about picking your stocks for your portfolio, bringing it from the macro, down to the stock picking level? So what's your investing style? What are the key attributes that you look for when you're looking at a stock?
Yeah, sure. So there's a few things that we look at that I think really important is that we're looking for a business, we're looking for a company that's essentially got an industry leading position. So we don't necessarily need the number one player, but we want a company with scale, and we want them to have a strategic position within the industry. So maybe they're the second largest, third largest, or maybe they're a strategic asset. They've got something unique. And those are businesses that make them quite attractive for someone else who's looking to maybe gain scale or enter a new geography. They tend to look at them as potential M&A targets. Obviously, we only invest in profitable growing businesses. So, you know, nobody wants to buy a leaky bucket. So you want a business that's growing, and you want a business that's profitable, generating good cash, low capital intensity. We like founder-led businesses. So, you know, we've noticed that founder-led businesses tend to do quite well over time. They tend to outperform most other businesses. But we don't mind if it's not necessarily a founder, but the board and management are aligned with shareholders. They have skin in the game. Usually that leads to good outcomes. Strong balance sheets are really important. So, you know, in many cases, we've bought companies where they have 10, 20, 30, 40% of their market cap in net cash. And, you know, obviously we don't mind some debt, and there are some situations which is okay, but generally you want to avoid highly leveraged companies. And then you're really looking for a company that's significantly undervalued. So some investors really focus on valuations in terms of, you know, is it worth $1 or is it worth $1.03? You know, we think that valuations are more like an indicative thing. They're quite fluid, and it's more a guide to where the company is heading. And really, whether a business is worth 90 cents, $1, or $1.10, it doesn't matter for us because we're trying to buy it at 50 cents. And that margin of safety is really the key here, because businesses are dynamic and they can change. And I'll show a few examples of how that happens. And then you know, if you can find that, and you're trying to find a business, and you're trying to, I guess, identify catalysts. What's going to drive other investors to buy your stock? You want, at the end of the day, investors to get excited about a story. You want them to drive the share price high. So you're really trying to identify catalysts that are going to drive that. And some companies, they might look cheap, but they're going to stay cheap for a very long time. And they're a big opportunity cost because there's no real catalyst to re-rate it. So you got to understand that. I think if you do all that, you know, that tends to lead to good performance and to a lot of takeovers.
Talking about which, that's a key part of your strategy, I know, is to look for stocks that might potentially be acquired. There's probably no magic formula there, but what's the sort of general stuff that you look for when trying to pick a company that might be taken over?
Yeah, so we're not buying companies in the hope of getting taken over. So what I've just spoken about, those key attributes, those usually, when you find a company that ticks all those attributes and characteristics that I just talked about, that usually over time will lead to two things. Either the market will re-rate the stock and it will go up, or someone else will buy it. And so by following this process over the last 5+ years, we've had 35 companies within our portfolios that got taken over, which is quite a lot. And so, it tends to work, right? I mean, so if you go to the next slide, actually, I'll give 3 examples that actually talk to those points. And what's interesting here is that at the time when we were buying these, there was nothing exciting about it, and they were quite oversold, but they ticked all the boxes, and I'll explain. I'll talk to them. So really, these 3 companies, Silk Laser Clinic, Symbio, and Pacific Smiles, 3 companies that we've owned over the last sort of 18 months, which all got taken over. And I think, although they're kind of in the past, I really want to just talk about it for a few minutes, because I want to highlight the opportunity and how we think and how what I've just spoken about translates. So if you think about Silk Laser Clinics, it's the 2nd largest skincare clinic in Australia. So again, a strategic position, an industry leader, right? It's a founder-led business. The managing director owned 8%. Again, tick. It had at the time, late 2022, when we were buying the stock, it had a really strong balance sheet. It was paying dividends, strong cash flow. And in fact, it was telling the market we're going to grow. So they were doing well. But the share price was sold off because if you think about late 2022, everyone was quite negative. And everyone thought we're going to drop into recession, and then consumers are going to spend less on making themselves look good and whatever. And we were talking to their demographic, and they weren't going to cut back on making themselves look beautiful. So we had this opportunity to buy a business at sort of 4 or 5 times EBITDA, maybe 8 times cash NPAT. And we also identified that Wesfarmers, who just acquired Priceline at the time, had part of that, got the 3rd largest player, Clear Skin. And so they were telling you they were going to buy other companies and expand. So we saw an opportunity. We bought it at $1.75, and Wesfarmers bought Silk Laser 5 months later for $3.25. So again, ticks all the boxes, but the reason it was sold off was for non-fundamental. It was more sentiment to the sector. Symbio, another example, it's a telco software business, founder-led, 22%. At the time, late 2022, it had a downgrade, got sold off aggressively, was trading at 130 mil market cap, had 40% of its market cap in net cash, was super profitable, trading at 3 times EV to EBITDA, even paying a small divvy, had a very strategic position in the telco industry in Australia. So again, ticks all the boxes. And, we saw an opportunity. What we saw is that it was sort of a bit of a once-off downgrade, and the company was telling you they're going to come back to growth and cut costs in the next 12 months. We bought in at $1.40 or $1.50, and it got a $3.15 bid by Aussie Broadband after they went with they had a bit of a takeover battle with Superloop. And again, ticks all the boxes. Was a once-off opportunity in terms of a downgrade. And then Pacific Smiles, that's more recently. So late last year, 2nd largest dental chain operated in Australia. It was kind of a founder-led business. Although the founder was not on the board, he helped change the strategic direction of the company in the last 18 months. Had a strong balance sheet. We're upgrading profit. And essentially what happened was a couple of stale large funds were exiting the register. They smashed the share price down to $1. It was for the first time ever trading on 5 times EV to EBITDA. The entire sector, every single dental business in Australia on the ASX have got taken over between 10 to 14 times historically. And we had this great business that was doing well and was being sold off for non-fundamental reasons, just large shareholders exiting. 2 months later, we got a $1.40 bid. 3 months later, we got a $1.90 bid. And then finally, there was an increase to $2.15. And then it hasn't really worked out. But anyway, we sold out at $1.90. We've made a lot of money on that. So again, 3 examples of where it ticks all the boxes, which I've just spoken about in terms of those attributes you look for. And it was non-fundamental reasons for the sell-off, which created the opportunity, which leads to a takeover. And that's kind of the idea of this slide.
Okay. We've just had a question from one of our viewers on how to identify founder-led businesses and asking in particular, does Stockopedia have this information? I can tell you that in Stockopedia, we have a section which identifies the key shareholders, major shareholders in a business. And what you'll find is quite often when you look there, you'll see 1 or 2 individuals with very large stakes. I was looking at Shine Justice earlier in the week, and there's two people there that hold 25% of the business. Now you can quickly then turn to the annual report and find out, well, who are those two people? They have to disclose that in the annual report. And sure enough, in that case, yes, they're the founders. So yes, we do effectively have that information. Any other sources you would use, Ron, when you're looking for founder-led businesses?
Sorry, I couldn't hear that.
I was just wondering, are there any other sources you use when looking for founder-led businesses?
I think what you said is right. I mean, at the end of the day, when we identify a company, we always go to the annual report, we check the registry. I mean, you can also look at the director holdings, the management holdings, it's all in the annual report. And also, when directors are buying or selling shares, it's obviously released to the ASX. So we follow that closely. Usually directors are part of the management team as well. So you can see what they're doing. And as part of that sort of release to the market, it tells you their entire holdings and everything. So yeah, you really have to look at that. It's very important.
Yeah, absolutely. And that all that director information and director shareholdings is also available within Stockopedia. Right, so let's sort of dig into a few stocks that you've invested in, and maybe talk us through what you find attractive in these stocks, starting here with Gentrack.
Yeah, so Gentrack, a really good business. We bought it a couple of years ago, mid-2022. I think it was $1.50 at the time, 150 mil market cap. So it has gone up 6 times, but we think it's gonna continue to go higher. It's a software business. It's been around providing billing software to the energy and water utility markets around the world, and also software to airports around the world. The biggest real opportunity here is really the energy market. And essentially, if you think about it, billing software is a critical part of a utility business operations. And, in order to replace or upgrade that costs a lot of money. And that, these customers are not very inclined to do it unless there's a reason to do it. And what's happening now in the world of energy transition, the way that energy providers actually generate electricity is a lot different from the past. You've got all these different renewable sources of energy, and the prices of energy is quite volatile through the day. So managing the way to bill customers is getting more complex. And on the user end side, customers now are no longer just having a sort of what's called a dumb meter, gets read every 3 months. They've got smart meters, gets read every few minutes. And then they're also not just consuming power, they're actually generating power through their solar panels, they're storing power in their batteries, and they're trying to sell it back into the grid and make money at certain times of the day. So this is getting really complex. And the existing provider to the majority of these energy companies, utility providers, is SAP. And they've put a sunset date that they're shutting down their software. And so there is now a massive churn event globally where every single energy utility company in the world has to update their software billing. And Gentrack is probably a top 5 player. They've got a really good product. They've been around for 37 years. And we think they're going to win part of that market. They've already upgraded revenue and profits 5 times in the last 2 years. And they're targeting $1 billion revenue at sort of 30% cash EBIT margins in the next sort of 10 years. And so we think that as they execute to that, the share price will continue to go higher. We think this will be an ASX. They just got included in the ASX 300. We think it's an ASX 100 stock in the next sort of 3 to 4 years.
Very good. Now, another company that I know you're quite interested in is Superloop. I'm coming to you today over a Superloop connection. Tell us what you think about Superloop and why you find that an attractive stock.
Yeah, so look, Superloop, again, it's a telco business, sort of both to the business wholesale side of the market and also to consumer broadband. What's interesting with Superloop, they've had a really good result at the February results, and then they were subject to a takeover by a competitor called Aussie Broadband at the time, and probably a very clever move by their management team. During that time, they stole and signed Aussie Broadband's largest white label customer, which is Origin Energy. And they brought them on to Superloop. And at the same time, they've actually issued stock to Origin. So Origin Energy now owns 10% of Superloop. And at the same time, are transitioning all their 150,000 subscribers from Aussie to Superloop. That will happen by end of October this year. That will add close to 20 mil of EBITDA. And Origin are very determined to get to 600,000 subscribers in the next 2-3 years. And if you do the maths, that could add another 50-60 mil of EBITDA. So Superloop is now forecasting strong growth. Last year, FY24, they did 53 mil EBITDA. They're targeting about 85 mil EBITDA in FY25. They got a strong balance sheet, net cash. We think they'll do further M&A. We think they'll continue to upgrade in the next 12 to 18 months. We think it's a really good business. The telco industry tends to consolidate quite a lot, so I think there'll be more consolidation. And the management and board, they're not founders, but they've shown to be quite savvy. And in fact, they've passed on buying Symbio, which I spoke about before. So they've shown that they don't overpay. They're quite, they're sort of quite disciplined. So we really like it. I think there's still good upside. And I think the next key catalyst is M&A.
I noticed they've been running at a loss up until now. Do you feel that the time has come when they're going to become profitable?
Yeah, so they're actually not at a loss. So this is a bit of an accounting thing. So, some companies, they have a lot of depreciation and amortization charges depending on the way that they sort of account for certain things, or maybe it's a acquired customer contract goodwill from acquisitions. So they're actually generating free cash, but the DNA part of their EBITDA is still high. But in FY25, the NPAT will start coming up quite a bit, and they're going to generate a lot of free cash. So, sometimes you got to kind of like look beyond the reported numbers because there's a few accounting stuff. So we like to look at the cash flow statement.
Okay. Another company that I know you've been following, SmartPay. What can you tell us about SmartPay?
Yeah, sure. So SmartPay is essentially, it's a payments business providing a sort of FPOS payment terminals, both in Australia and New Zealand. So think about them as a mini Tyro. Everyone knows Tyro. They're in Australia, they've been growing over the last few years from zero market share to they've got about 20,000 terminals. Now, if you think about Australian market, there's 1 million terminals. Obviously, you've got Woolies and Coles, and those guys, you can't touch those. And then you've got the big banks. And then there's probably about 250,000 terminals that are with small businesses, convenience stores, restaurants, beautician stores, and so on. That's the market that Tyro and SmartPay are targeting. So they probably got about, 8% of that 250,000. And they think they can keep growing. And they clip a ticket on every transaction. In fact, they kind of invented the surcharge model in Australia. So when you buy a coffee and they add another 8 cents on top, you can blame SmartPay for that. So it's become a bit of a trend, and it's also become a bit of a political hot potato at the moment. And that's driven some, an industry review by the RBA into surcharging. Now, that is a little bit of a risk if they do ban surcharging completely. I don't think they will, but I think they might kind of more regulate how much businesses can pass on. So a lot of businesses are probably profiting from it and passing on more than it actually costs them, which is not allowed. So that is something to watch. But what's interesting with SmartPay is not the Australian part, it's the New Zealand part. So in New Zealand, actually, they're the big boys. They have about 25% of the market. And what's happening in New Zealand is that up until now, they just charged a merchant terminal rental fee a month. So they weren't actually benefiting from getting a clip on the transactions. The structure of the industry is a bit different. I'm not going to go into it too much. But the way to think about it, they've just transitioned that business to their current processor in Australia, which is Casca, and they're going to start charging and taking a clip of the ticket. So if you think about it, in Australia, they make about $4,500 of average revenue per terminal per year. In New Zealand, they're currently making about $400. So once they transition the entire 35,000 fleet to that, you're talking about 10 times upside in terms of revenue, and half of that is profit. So if they're able to transition the entire base, and these are their customers, they just give them a new terminal basically on a new contract, we think they can add 30 to 50 mil of EBITDA compared to the current 22 mil of EBITDA. So this is the story here. And there's a bit of risk in Australia in terms of regulations in the short term. So just keep that in mind. But if they execute in New Zealand, this stock is worth more than double.
So looking at the chart there, it's been in a bit of a downtrend for the last, 8 to 12 months. Is that due to that risk around the surcharge risk?
Yeah, I think probably the first half of that downtrend is probably just the stock ran too hard ahead of itself when they were launching into New Zealand and they announced it. And I think the last couple of months, that is due to that regulatory review and risk. So yes.
Okay. All right. Just a different sector. Clearview, company that the wealth management sector. What's your feelings around this company? Why are you attracted to it?
So this is not a wealth management business. This is a pure life insurance business. They sell life insurance through the advisor market. So in fact, they had a wealth management business, but they divested it. So they're a pure play life insurance business. If you think about the life insurance market in Australia, it's about $10 billion of in-force premiums. So they've got about 3.5% market share of in-force premiums, about 350 mil. But of new business, they're actually gaining about 11 to 12% of all new business. So they're growing about 4 times their current market share. So if that continues, their in-force book will eventually grow from 3 to whatever their new business market share is. So they're obviously taking share, very profitable business, 35 mil of NPAT. They're trading on a P of 9, pays a really good divi, about 7% roughly grossed up. Very cheap. A life insurance company has an embedded value, essentially. The future discounted cash flows of their policies, they're discounted back to today. That's like 91 cents with franking. So trading at a huge discount to that. The largest shareholder is Crescent Private Equity. They did a strategic review a couple of years ago. We thought they were going to sell and then we'd get a takeover bid. That coincided with rising interest rates and all that. So that I think put that on hold. But I think right now they divested all these wealth advice business. So they're a pure play, super profitable, cashed up, paying a divvy. And they've got a target in FY26 that they're well on track to hit. And if they hit those numbers, then in FY26, they're going to make 7 to 8 cents earnings per share, pay you a 4 to 5 cent divvy. And if you look at the current share price, then I promise you, if they do that, they're not going to trade at 54 cents. They'll be probably more like $1 if they don't get taken over by then. So I think this is a really good one. You just got to be a bit patient. And the real catalyst here is for Crescent Private Equity to sell down their holding and create more liquidity, because I think that is a bit of a perceived overhang on the stock.
Okay. Well, there's some really interesting insights there, Ron. Thanks very much for that. Now, if you do have questions, now's a good opportunity. We're getting towards the end of the presentation. Do type those questions into the chat box on the right-hand side. We have had a couple come in prior to the webinar as well, which we'll get to in a moment. But just before we do that, Ron, if people want to know a bit more about your business, what's a good way to go about getting your insights?
Yeah, so we actually write a lot about stocks. So we have if you go to the website, you click on this QR code, you can subscribe to our newsletter. Every week we publish a couple of articles. We talk a lot about ASX stocks, a lot of small caps, some international stuff, some macro stuff. It's really interesting. So definitely subscribe. And you can also find, if you dig through the website, if you go to the funds that I manage, you can actually read the monthly reports. And obviously I talk about the stocks that we invest in. So you can get a lot of information on that.
Cool. Yeah, take advantage of that, people. Just click on that QR code there, or not click on it. You know what you have to do with your phone, and go through and sign up for their newsletter. So just turning to some questions now. We had a question come in ahead of time from Peter. Now, I know you're not a resources guru. I know that's not the space that you guys are investing in, but what can you tell us about the energy sector? What are you seeing there in terms of trends?
Yeah, look, so as I said, as you mentioned, we don't invest in resource companies. So obviously this is not something I'm an expert on. There is definitely, there is a huge energy transition that's happening. There's no doubt about that. That's going to cause disruption. And I guess, although we don't necessarily have a view on particular energy sectors, we're kind of playing it through the company which I discussed about today, which is Gentrack. So essentially, this energy transition that's happening is driving these utility companies to make changes to their software stack, and Gentrack is just riding that huge mega thematic. And so you're actually buying a super profitable business that's benefiting from the same, trends and tailwinds that you're having in the sector, but in a different way. So it's maybe kind of like a indirect picks and shovel play to the sector.
Okay, great. You mentioned a bit earlier in the presentation about AI and your views as to how that's really potentially an inflection point in the last 20 years or so. What companies in that space are you looking at? And we have one question here from Kirby about NXL, which I know is also in that space.
Yeah, so look, AI is real. The problem is on the ASX, you don't really have many AI, businesses, and also especially ones that actually make profit. So there are two companies that I would say that we own that are real AI businesses. So the first one is, like Kirby says, it is Nuix, NXL. We do own it. I think this is it's becoming a really good growth story. They've got a software which has been around for a while, and essentially it sort of helps to kind of process a lot of data and make sense of data for a lot of companies, whether it's large enterprise, governments, law firms, defense, all kinds of businesses. They're very profitable, they're growing, but they've launched Nuix Neo, which is kind of like their AI version of their program. It was launched 12 months ago, and it went from 0 to already, I think it's 14 mil of annual recurring revenue, which is quite incredible. And so if you think about it, they're generating, I think it's sort of 2 to 3 times the revenue per customer by selling them Nuix Neo than their current software. I think they've got 23 customers on that. They've got 1,000 customers on their books at the moment. If they were just to convert some of those, I think you're going to see huge growth. It's not cheap, but it's going. If they continue to grow at the current rates and they're forecasting good growth, and it's obviously got that AI thematic, then I think it's going to remain expensive. And this could be another WiseTech, Pro Medicus type of business where it will always look expensive, but it's always going to keep growing, and it's in that perfect thematic. So we think there's some big upside there if they can continue to execute.
And the issues they had when they first floated, they're all in the past now?
It's all in the past, different managements, different board, and most of that legal issues have been resolved. So it's not, there's a couple of small cases there, but it's nothing serious. It's all in the past.
Okay. Could you also maybe just talk briefly to this company, AI Media Technologies?
Yeah, so look, this is probably the best AI stock on the ASX. We're really excited about it. I should mention that it's our most highest conviction in the fund. Although we did buy it 8 months ago at 28 cents, it's gone up a lot, but I think this is a potential 10 bagger in the next 3 to 5 years. They provide live captioning and captioning services to the global industry. Now, what's interesting is that this industry was starting to be disrupted by AI, and this is a founder-led business. So the MD was the largest shareholder, he's got 15%, and he decided to disrupt himself, and he created this AI program called Lexi. And with the advancement of AI, now the AI engine Lexi can do better captioning than humans. And when that happened, then this huge opportunity has arisen. So essentially, where it would cost a company $80 an hour to use a human captioning provider, with Lexi and AI, it costs $8 an hour. So not only it saves so much money for their customers, so everyone is just taking up, give me as much as you can. And it's sort of like getting all you can eat, the shrimp buffet, for cheap. So you're just going to buy as much as you can. They're actually creating sort of new industries are emerging that I want to use it, because before $80 was expensive, and now $8 is nothing. So it's taking over. And what's interesting, so they had this transition where the low margin services revenue was declining, but this high margin, high growth, we're talking 85% gross margin tech revenue is going up. And this inflection point just happened. So more than 50% of their revenue is tech. It's growing at 35 to 40% at 85% gross margin. The business is actually very profitable. They've got this high amortization from acquired business 3 years ago. So don't look at that. Look at their cash flow. They're generating free cash. They got good cash on the balance sheet. And the managing director is forecasting that the entire business will be tech revenue in 18 months from now. And he's forecasting 150 mil of revenue and 60 mil of cash EBIT in 5 years. And he has a very clear strategy of doing it. Everyone is awakening to it, and it's just being discovered. You know, it was a 70 mil business only a month or two ago, and now it's a 150 mil business. But we think this would be $1 billion business in the next few years if he can show the market that he's getting to that 60 mil of cash EBIT. So it's a really good story.
Excellent. That huge jump in the price just a month or so ago, what was the catalyst there?
FY24 result.
Okay. Now, I'll just throw a couple at you. If you're not familiar with them, just say so. But we've just had a couple of questions from some of our viewers. Stock code IPG.
Yeah, so we own that one. So this is IPD Group. The code is IPG. They're essentially an electrical wholesaler and distributor. They're actually another way to play this whole AI thematic because they provide all of these electrical components and parts that are used in data centers. So there's a lot of data centers being built, and there's a lot of different electrical components and wirings and all kinds of stuff that this company supplies. They also provide services to the electric vehicle market. So, you know, obviously there's a transition there, and they help companies sort of put electric vehicle chargers. They got a contract with the NRMA. Very profitable, founder-led business. The board owns 30 or 40%, I can't remember. They have made some acquisitions, pay good divi. They had a really strong result. We think they're worth another 20%, but they're looking at some acquisitions. So obviously, as they keep growing and acquiring, that valuation could keep going higher. And again, you're playing to that thematic of data centers, electric vehicles. And so it's a really good, strong tailwinds for this business. And they've shown a really, we bought it when they listed 2-3 years ago at $1. It's now $5. We think it's just going to keep going. It's kind of like another kind of Dicker Data kind of story.
Excellent. And any comments on GDC?
Yeah, so global data centers, we finally sold out of the last bit of our shares today. So we bought that mid last year at $1.50, and we just sold it for $3.27. Basically, this was probably one of the kind of cheapest data center plays on the ASX, but it's already done and dusted. So essentially, if you go back a year and a bit ago, they had 3 data center assets. They had an old data center in Perth. They had a bunch of edge data centers in France as part of a joint venture called ETICS Everywhere. And then they had 1% of the sexiest data center business in the entire world, which is AirTrunk. What happened was the business was trading at a huge discount to its asset value. And then the management was essentially by a large shareholder incentivized to sell everything, get the share price to $3. You guys make $30 million. That's simple. And when we saw that, this was like a classic Charlie Munger saying where, you show me the incentives and I'll tell you what the outcome is, right? So this was kind of like, it was a bit obvious what's going to happen. So we bought it back then, and that's exactly what they did. They sold everything for as much as they could. And AirTrunk just got sold. So there's about $3.60 of cash proceeds. And that will obviously take a few times to get back to shareholders. So it's trading at about $3.30, which is your traditional 5% arbitrage, time value of money kind of play. So if you want to make kind of, if you like those arbitrage plays of making kind of 4 or 5% every 6 months, then there's probably a play there. But otherwise, it's about done. So, yeah.
Okay. All right. Well, we're just about out of time. Just a reminder, everyone, if you want to take up or if you want to subscribe to the newsletter that Ron and his team put out, if you click on the offers little basket, the little shopping cart on the side there, you can go straight through to their website where you can sign up. So I'll just wrap up by saying a really big thank you to Ron. Thanks for coming and joining us today.
Thank you. That was fun.
Excellent. And thank you to all of our viewers for tuning in. I hope you found that informative, and there's a lot of really great information that you can get out of that. So I encourage you to subscribe to Ron's newsletter. Also, get along to stockopedia.com.au and sign up for a free trial if you haven't already done so or you're not already a member, and take the opportunity to look at some of the stocks that we've talked about and how they rank within Stockopedia. So that's all for today. Thanks again for tuning in, and we'll see you at our next event. Thank you.